Fook Hien Yap is senior investment strategist at Standard Chartered Bank. He's with us. Fook, good to have you here. This bond market scare, is this going to pass once again? Or it'll be with us for some time? And that question, right, at what level does it start to hurt? What's your sense?
Yeah, no, thanks for that. I think the bond levels, yeah, it has been going up. The yields have been climbing. I think, wind back a month ago, I think the market was looking at 3 or more than 3 rate cuts by the end of the year. And now I think a lot of things have changed. Obviously, market concerns have eased a bit. So we're looking at less Fed rate cuts. That's on the short end. And then on the long end, I think we've seen it climbing as well. Also affected a little bit by the view on how there's less Fed rate cuts affected. But obviously now the discussion about the fiscal spending and the tax package there affecting the longer end yield. I mean, our expectation actually is that the 10-year, it will move to 4 to 4.25% in the 12-month, 1-year time frame. That is our own view, because we do expect Fed rate cuts to come in later on to support growth as it slows down. But look, I mean, yields are going up at the moment. We see a lot of discussions going on in Congress, concerns obviously about the fiscal spending and how the fiscal deficit could unravel it in the US. But I think a lot of this, I think, is within the control of the politicians and the Trump administration. We do believe he is sensitive to what the bond market tells him, so that they will be able to come into some kind of agreement. But I think, much longer term, we're looking at 20, 30 years, there are inflationary forces, if you like. But if we look at the 10-year and how the Fed is going to be reacting, I mean, we're looking at it coming down to 4 to 4.25%. I mean, to your question on when it starts to hurt, I think, yeah, I mean, it's hard to say, but we are still constructive on the equity market. Like I said, looking at a 12-month view, at least, I think looking at the Fed coming in to support growth, we do expect yields to be coming down. And more importantly, we shifted the narrative very much from a trade war now into something else. But we think the trade war and how it affects recession is still going to be the key for equity markets.
But on the whole, yields inch lower to 4.2%, aided by a Fed rate cut, and US equities is still very resilient and headed higher. So there's a new acronym, right? Fook, ABUSA. Anything but USA, challenging the entire exceptionalism. You're not in that camp to ditch America.
No, we're not. I think post Liberation Day or 2nd April, when the tariffs was shocking to the world, we saw a little bit of that when the dollar weakened and yields going up, and we saw some rotation coming out of US assets. And I think a lot of that was due to the tariff shock. And we did see the US exceptionalism that's been going on for the last 10 years, perhaps, pause. We think that is a pause, actually. I think what happened in Geneva in terms of the agreement between US and China, look, it came about very quickly and it was better than expected. So we think actually that was a very significant moment in terms of the negotiations. We do see a bit of the Trump put in action there, that he's willing to support growth and support the market. So US exceptionalism, I think, took a pause, where we don't see that going away at the moment. But the US market is still a very big chunk of it. We think attractive growth is still there. AI is still there. It's still early days into AI spending and earnings growth. So as the trade war fades, we believe the investors can still refocus again on the AI trend. And it's still going on there. I mean, the spending is there. Companies are willing to invest. And that's going to be supportive for earnings growth in the US.
Okay, all right. Hi, Fook. Good morning. Good to see you. And, Fook, I think another way of tackling with Trump's tariffs is talking about a jet. Qatar did that with, gifting them the jet. And I think last night, the South African president as well was joking, I don't have a jet plane to give you. And he said it would be nice if you did have one. So interesting times. But talking about the global equities, I recall you saying that India was a market that you liked a couple of months ago. We've had a very, very good run. Post this run, where does India feature in your scheme of things from the global equity markets? And also, I think you said that you'll be a buyer at gold closer to around $3,000 an ounce. So you're positive on that. Where is it headed?
Yeah, thanks very much for that. I think, we do have a core holding view for India at the moment. Within Asia, our preferred market is still China. And India, I think the recovery has been very, very good. But The earnings revisions is still a bit negative for the month of May. I think it's less bad compared to April. I think April we saw much more negative earnings revision. May it is still negative. So I think that is actually what keeps us cautious. India, as you know, very strong growth, but the valuations are quite high. So we think we really need earnings revision to turn a positive to support the high valuations in the market. But look, I think structurally in the medium term, India continues to be a very attractive market for us. As I said, as a core holding, as what we tell our investors. Our preferred market is China, which I think the reasons are not new, but in terms of the valuation in there, it's attractive. Stimulus will be there to be supportive. And they have their own AI and technology developments as well. And the more recent news about the agreement in Geneva, I think is supportive of China. So I think to your question on gold, I think we do like gold. I think we have an overweight view on gold at the moment. Our 12-month target, 3,005. So yeah, we do see it as attractive to have in the portfolio to hedge against your recession and inflationary risk.
All right, Fook, thanks very much. Good speaking with you. Appreciate your time here on CNBC TV18.